lend against the accounts receivables, unless we have a subordination agreement from them.
Jim, what happens in the event that during the course of a loan, a federal tax lien comes into play?
If we do our due diligence right, which we find in the beginning, there is no federal or state tax, and it's filed subsequent to that. We have given notice of that. We have 45 days, there's a 45-day window that we have under the rules and regulations by the federal government that we can continue to fund, but after 45 days we would need their permission to go forward.
And if we don't get their permission, what happens?
We are not in first place any longer.
Their lien trumps our lien. They become a first lien holder?
Yep.
Okay.
Now the next one is the proprietorship and the partnership and the sole proprietorship lien. Joe, you're a little bit more expertise in that area than I am.
Yeah, this is a very complicated area, and if you work with legal counsel when you're doing these initial searches, it's a good time to get them involved. Because of the nature of a partnership where each partner is jointly and severally liable for the debts and obligations of the other partner, it's very important to do the searches at the county level, not the state level, under the name of the partners. And where it gets complicated is if you have a married woman, for example, who uses her maiden name and her married name, you'd have to do the searches on both her married name and her maiden name. If you have an individual who, like me, my name's Joseph, but people call me Joe, you'd have to search under both my nickname and my formal name, and the borrower has to give you official documentation that you can rely on to choose the name to do the search with. So for instance, a couple of months ago, we did a transaction with a partnership where there were 4 partners. Husband and wife were 2 of the partners, and 2 other gentlemen were partners unrelated to the husband and wife or the other partner. And between the 4 of them, they had 16 different names. So we literally had to do searches under each of the 16 names before we could commence the transaction. And we picked up things like got a copy of a license, got a copy of a birth certificate, got a copy of a passport. But we noticed on the emails that they signed their name, Bud or what have you. So you actually have to do the search under Bud. And it's possible to do these kinds of transactions. And the other problem you have with a partnership is it's very easy for the partnership to change its name prior to or post-funding. So many times what your lawyer will instruct you to do is to formally file the name of the partnership with the county that they operate in so you can file the lien on the right entity as well as the partners. So it's very nuanced, and if you're not comfortable with this particular aspect of searches, I suggest you get legal counsel. Jim?
Yes, absolutely. I agree 100%. Very tricky. Personal background checks. Another very important due diligence process that we go through. We like to look at the personal background checks because we want to see if there are any tax liens, federal tax liens that they have. Maybe they haven't been filing their tax returns. Maybe they have suits and judgments against them. It kind of gives us an idea of the character that we're dealing with. And we like to know that up front. That's basically the most important reason we do personal background checks. Litigation searches are just the same. Follow suit with the personal background check. You're looking for litigation. If there's any litigation against the principal or even the company that you're dealing with, it's not a good sign to see that they've been sued and there's pending lawsuits or judgments against them. It's something that you want to get explanations for. Maybe there are reasons for it, but you want to know ahead of time why have you had judgments, suits against your company, and please explain it. There could be a logical explanation behind it, but you have to do it just to protect yourself.
Just to give you an example, we have a transaction that we're engaged in right now where when we did the litigation search, we found a lot of litigation on the particular company, and it was over use of trade names. and they had produced a custom product with a trade name on it. The entity that was named, that the product was licensed under, thought that they had clear title to the name, and they didn't. A third party filed a lawsuit and created all sorts of havoc for the client of ours. So in that particular case, it's litigation, but it's not something that would preclude us. The litigation was over, by the way. It was not something that would preclude us from closing the deal, because there was a logical explanation. The lawyers were able to brief us on the extent of the litigation and how they were a victim of circumstance versus they perpetrated some tort or something. JP is going to go through some of the different aspects of due diligence that we use to sort of come up with a complete picture of what the client is like.
Thanks, Joe. Thanks, everyone, for joining us this afternoon. This part is very important, since this will determine the probability of, as we all want to make sure that at the end of all these transactions, we are paid back according to the terms and conditions of the relationship that has been or will be set up. The first thing we want to do is order a Dun & Bradstreet report to assess the current and future health of a potential client and the client debtor. And one thing you have to make sure is that the legal entity that you're ordering the Dun & Bradstreet matches with the document, the legal paperwork, as Jim tells us all the time, that's submitted by the client, to make sure you have the parent, you have the subsidiary. You should check the name, the address, the phone number to match, to make sure that the D&B information that you have is on the customer or client that you have. Basically, I'm sure most of you know that the Dun & Bradstreet report goes through a company summary, giving us the years in business, the corporate linkage, the predicted scores, trade payments, public filings, special events, history of the company and management, and financials if they have any. The next step in our due diligence process is to send out our new customer fact sheet, which is sent out for completion. The fact sheet requests basic customer information on either the customer or the client to set up this information into our computer system. The name, the address, the bill to, ship to, the federal tax ID number, D&B number, contact information. Again, to make sure that everything is properly cross-referenced to the business entity that you're going to be doing business with. Then you should request, the next is financial statement. We like to get 3 years of fiscal year-end financial statement, as well as the most current quarterly statement with the comparative of the quarterly statement from the prior year. Then put the financials are then input into our internal, we call it the credit risk assessment model, which does certain highlights on the balance sheet and the PL, ratios and metrics. This provides comparative analysis of the company ratios to the other firms in the same industries. Some of the ratios that we input in here are there's really 3 basic categories of ratios. Efficiency ratios, which are the days sales outstanding, and the inventory turnover. Next one is profitability ratios, which are return on sales, which is the profit margin, gross and net, and the return on equity, or the return on net worth. The last ratios are the solvency ratios, which are the quick ratios, current ratios, and days payable outstanding. And we go on to the next category, which are bank reference. We highly recommend that all accounts you do contact the bank to provide information about a customer, which will be used through analysis of their bank history. Basically, on a depository relationship, You want to make sure of how many years they've had the depository relationship, whether it's satisfactory, unsatisfactory, whether there's been any insufficient funds, that the checks were returned. Then on the loan side, what kind of loans, secured, unsecured, the type of collateral you have, whether there's loan covenants, are they in compliance, are there cleanup requirements. The last category is the trade references. This is to verify the creditworthiness of a customer through analysis of the trade vendors with which the firm does regular business. These should include when the account was opened, the high credit outstanding, the amount past due, days past due, terms of sale, manner of payment, and any comments that the trade references might want to share with us.
So all of this information is collated and analyzed together, and we come up with a final underwriting. And Jim's going to go through some of the inconsistencies that come up as a result of this particular analysis.
Yes. Thank you. On the inconsistencies, especially in number one, the multiple company names, that holds true for both the client and the account debtor. You could have a client that has an office in New York City, but incorporated in Delaware, and they could be different names, and they're incorporated in different states. So it's important when you look at these inconsistencies. Why is the company incorporated in Delaware, but they're doing business here in New York? And maybe they have different names. Maybe it's a DBA name. Maybe it's an AKA name, otherwise known as. You have to kind of zero in and make sure that these inconsistencies are explained. And the addresses is the same, just as I was saying. They could have different addresses. Even the account debtor could have different addresses. Maybe their headquarters is here in New York, but they got branch offices all over the United States. When you go to get verifications or the payments, you might have to go through the chain of command. Start here at this office and go right down the list until you find where you want to go and who you want to talk to make sure that you have the right company name.
So Jim, let me ask you a question. If I have articles of incorporation that indicate XYZ company and I have a contract with just XY company on it, what do?
We bring it up to the client, and we ask them point blankly, why is there an inconsistency in the names? And then we ask them that it needs to be changed. And if we go to their customer, we ask them directly to change it, and if they give us an explanation it can't be changed because if they have it under a different name, then we do not proceed.
Okay. So if the names don't match, you run a significant risk of not getting paid back because someone could claim that the contract is with this company.
None of that. You're dealing with the UCC filing as well.
Right.
Right. We have perfected our UCC filing under the name of its incorporated. We perfected it under. So it has to match the name that's on the contract.
Okay. So if the articles of incorporation and the contract do not match, then we don't have a security interest in that particular receivable or inventory or the proceeds thereof.
That's correct.
And therefore, we should step back and not fund that particular transaction until everything is in conformity.
That's correct.
Okay.
I believe the company history versus the business plan is your area of expertise.
Yeah, a lot of times what will happen is the company that wants to borrow will put together a business plan to facilitate the loan. And it takes them longer than expected to get the loan, and the business plan is not updated when it's submitted to you. It still has, it could be June, and the first 6 months of the year they had indicated that, their sales would be significantly higher than they are. This to us is a significant warning sign because you have an overly optimistic principal who isn't updating his documentation when he submits it to you. And we find that when these kinds of situations occur, there's a good chance that if you do make the loan, your loan isn't going to perform as anticipated because the projections may be unattainable. The principal may be overly optimistic about the ability to increase market share, the acceptance of the product. They may have already missed the sales cycle for their product by losing the 6 months. So you have to be very careful about these kinds of discrepancies when you compare it to the actual performance over the same period of time. The other areas we look at are their financials, and many times you'll receive compiled financial statements where the accountant is just reproducing management's representations, and the value of the assets are way overstated in comparison to the performance of the company. Or you get a personal financial statement where the value of the company, which is the main asset of the principal, is shown as a multi-million-dollar valuation, yet the company has little to no net worth or a modest net worth on its balance sheet. The other things we look at is if the company is being financed on credit cards or long-term debt. If there's too much of it, the last thing you want to see is your loan going to pay old debts and leaving no room for working capital. So there should always be reserves that are available post-closing to ensure that the company can meet its business plan and grow, because that's why you're giving it more capital through a loan. Prior bankruptcy is a red flag. A company can file Chapter 11 without any statutory period passing, as an individual has to wait a certain number of years before they file again. So that's a red flag. Limited cash reserves are another issue. They need to have some liquidity outside the scope of the loan, or else you're going to end up consuming the entire loan at the time of closing, and a week or two after your loan closes, you're going to be in no better condition than you are now. The other issue that we find somewhat troubling is untimely tax filings, and that may be an indicator that there are record-keeping issues within the company, or the staff they've hired is not really qualified to document and maintain the records of the company. That means that when you do a borrowing base or an assignment or an inventory report, the reliability of the data you're going to be receiving could be in question. The next issue we look at is the stability of the business. And again, we then analyze the litigation, whether it's excessive or not. In the last 6 weeks, we received a deal that was so complicated, I'll never forget it, I think, for the rest of my life. There was a limited liability company formed in one state. They had operations in 16 states, and they formed 16 different limited liability companies, of which they owned 51% of each of those limited liability companies, and they had a different partner in every state. So when we looked at this organizational chart, we said to ourselves, how on earth will we know where the collateral is coming from? Even if we filed UCC1 financing statements on all of those entities, as a lender, you can get joint and several and cross-collateralization and everything, but at the end of the day, you have to be concerned with things that are things like fraudulent conveyance, which means that you've engaged in a loan transaction and the unsecured creditors have been disenfranchised in some way as a result of the transaction, which could invalidate your loan. So when you get these very complicated business relationships and entity relationships, it's a warning sign that you could be susceptible to fraud or fraudulent conveyance issues. Again, I get back to the overly optimistic growth projections. It's very difficult, unless you're a technology company that can just print software all day, to grow more than 10 or 15% a year and grow in a measured way with the appropriate staffing without the company getting completely out of control. So when you see very optimistic growth projections, there's a good chance that they're unattainable. The other trend that I've seen over the years is the use of consultants. And many times it's a principal that actually owns the company through a third party who is passive, and they have some kind of a problem in their background, whether it's a regulatory issue, a felony. And so what we do is anytime we see people that are consultants that have a very significant influence on the company. We include them in our due diligence. We do personal credit checks on them. We do background checks, and we sometimes make them sign guarantees or indemnities because of their emphasized influence on the company. And another thing, which is extremely minor, is insurance. If a company comes to you for a loan and they don't have insurance, there's something fundamentally wrong with the company because it's not hard to get and it's reckless to operate without it. So that to us is a big red flag. JP is going to go through now how we establish credit lines for the account debtors and all the different variables that come to form the credit write-up.
Okay, now that...
leap in for a sec. This is Tim. I just did notice we had a question from Lawrence about whether something's printable. I don't know quite what the thing was. That might...
Lawrence, we can email, if you send us your email, we can send you the PowerPoint slides, if that's what you'd like.
Okay, let's go on to the credit write-up. Now that we've gathered the necessary information, we need to determine and assign credit limits with expiration dates for both the client and the customer. To determine this, we have to, number one, review the requested facility or a combo of facilities that the client is requesting, such as PO financing, factoring, spot factoring, whether we need to do funds control or not. Then number two, we have to do a risk assessment on the customer and or the client. Number three, we have to ascertain what the, and this is very important, what the available collateral is going to be, normally accounts receivable inventory. Then we have to project out what we anticipate the advance rate to be based on dilution reports. And then we have to determine the fees.
So, JP, what's the importance of dilution?
Well, dilution is to ensure, and I guess the best way to do this is to give everybody an example. If we are using an accounts receivable for $1,000 and we advance, let's say, 90% against that, we would have an outstanding loan of $900. And at the end, we expect that the customer will pay us $1,000. Now, if we receive a payment, let's say, for $800 against the $1,000, which we advance $900, you would have a deficit there because you don't even have the fees charged in there. We would have a deficit of $100. So if that continues, then you have to ascertain whether perhaps you want to reduce the advance rate. So basically, dilution is anything from the amount of the invoice that's been assigned to the final when we get a payment at the end of all of these transactions. So very important to track that.
So when you do your dilution analysis, you simply take the net that you receive on an average basis throughout the entire accounts receivable, if we're using that as this example, and let's say the dilution is 5%, your net receivable is 95%. So when you go about to create your advance rate, you're going to base it on the net value of the portfolio in general, so that if you're making a 90% advance rate, you're doing it on 95%, not 100%.
That's correct.
Okay.
And then if we historically, the dilution number is higher, we might say, like in your example, if it's 5%, as you know, the risk manager here, I would probably say, okay, let's build in a 10% extra, and then the client at the end, if it does pay in excess, they'll be able to get that in reserves. So,
okay.
Anyway, now that we've done all of this work and we've gathered this information, we internally do what we call a quick first internal rating. This is basically a three-liner, if you would. Number one rating would be that based on the information that we have, the account, it looks good, there's no problems, it's okay to proceed with doing the due diligence or the report. Normally here too, whether we approve it for a line or decline it, we tell everybody there has to be 3 reasons either to approve or decline the credit or the application. The second tier would be that one that we would possibly look at the information but say, you know what, we need some additional information, but you know, if I get this information, perhaps we can do the deal or not do the deal. Number 3 would be decline based on 3 parameters, which we think are, you know, derogatory on this thing, that we would go into committee and make a decision on whether to proceed or not. So now, after we do this, the account manager would proceed in preparing what we call a credit package, and it is his role to make sure to determine if you have all or some of the following, which we already went through: the D&B financials, bank, trade, customer, client, site visits, management discussions. Then we would have to do a write-up explaining the expiration date that we want to put on the account. And usually this is based on receipt of the fiscal year end. So in other words, if the fiscal year end is 12/31 calendar year, we might make the expiration date 3/31 to make sure that we look at the year-end figures for the following year. And also, you always have to look at the interim financial statements. Then you have to look at the risk assessment. If it's a riskier account, perhaps you want to require a shorter expiration date. So you could start out annually, 6 months, quarterly, monthly, and in some cases on our portfolio, we have weekly reviews of the credit lines here. Then these accounts are presented on a weekly basis to the credit committee for review and sign-off. We review the pending deals, new deals, and our current portfolio. And we always keep in mind the account manager is required to give us the ratios in regards to the funds employed or your loan balance versus the collateral. Then we assign lines of authority and sign-offs based on the exposures on these particular customers or clients. So in other words, the account manager, you can have authority up to X amount. Then it comes up to the risk officer, the next step. Then it's the managing member, and then at the end, the board of directors to sign off on this.
So JP, sometimes in the credit committee, we would want to turn a deal down and because there's some flaw in it, and we say, if the client's willing to do this, in the case we had a transaction that we approved last year, which we wanted the client, it was a purchase order financing transaction. We wanted the client to contribute about 30% of the value of each letter of credit that we issued on their behalf. And that came out of a discussion in the credit committee, and everyone was pretty positive that the client wouldn't agree to that particular condition. But lo and behold, it was presented to the client accepted, and we've got an excellently performing account going on a year now, and they continue to put up those types of deposits, and it reduced our exposure at any one time to about 65% of the face value of an invoice, and about 70% of the cost of goods. So we're very comfortable, and the client sales are growing. And maybe next year, if we're still in the credit, we may reduce the deposit requirement by half.
Right. That was one. Like, we went into committee, and I think there was about 50% of the people said, we're not doing this deal. And we said, well, maybe if we can work around these terms and conditions. That's why we lowered, like Joe said, we lowered the advance rate. We did a PO facility along with a factoring facility. So at the end of the day, we watch. In fact, today I just had a weekly conference call, and we go over the collateral, the inventory, the accounts receivable, and we go what the loan values are. And we even have another bank that is involved in a tri-party agreement, which made this deal a little bit crazier, but at the end of the day, I think it's working out very well. The other bank is very happy on how we're handling it. The client is happy. The client is growing.
Yeah, and he could have been out of business by now. So, okay, we have to move along. So the next slide discusses really using data rooms. And when I first started in prehistoric times, we used to use files, and people had to share documents or make photocopies of files. Now you have these data rooms, which allow the entire team to see documents as they come in without resorting to receiving partial information in multiple emails. It's also useful for the client to see what they've sent to you in one centralized location. It's important to archive the due diligence information on your private server so you have a redundant copy, and the data room facilitates all of this. As you review the documentation, you can standardize how you categorize the data so that, a year or two from now, when you need to look at a document that was involved either in your initial due diligence or in your continuing due diligence, it's very easy to find, and it's at your fingertips. It's also very good because it tracks the amount of time that people spend in the data room. So you know how well read people are with regard to the client matter. And in many cases, if people aren't reading the source documentation, they're relying on summaries of other people, and they're not using their experience to underwrite the transaction properly. So data rooms facilitate all of that. We use them now all the time, and they're a very efficient way of collecting data, analyzing the data, and making sure everyone stays informed. Jim is going to take us through continuous monitoring because that's a very important aspect of getting paid back.
Yes, thanks, Joe. It is a very important aspect of how we get paid back. It's very, very, very important, as a matter of fact. Number one, verify consistency between the real and what is on paper. I can tell you from experience, and I got many more stories I can tell you, but we're running behind in time, so I'm going to try to make this quick. One quick one, I had a general contractor that we were using here to build a house out in Long Island. And there was a field audit, a CPA field audit done, and I was reviewing it. And upon my review, I came across one of the disbursements on the report that showed there was a pool deposit made. Now, I know because I make field trips out to the job site every month, and that's another requirement that I would recommend, that there is no pool. So I went and confronted the general contractor. I said, look, you have an entry here, and it's kind of strange that there's no pool here. But there is a pool, but it's just not at that location. So what I'm trying to say is that you have to go and look at what's on paper and determine what is real. And you do that by going out and physically visiting either the client or even if you're going to go out into a job site or to a warehouse, whatever it might be. It's important that you go out and make observations. Same thing when you go out and talk about the workforce. Maybe you make observations about their work area. Talk to an employee. See if they're happy. See if they've been paid. Make sure that the workstations may have different names on them. Maybe you've got subcontractors. Maybe you ordered General Electric light fixtures and you have an unknown light fixture there. Observations, trends, or multiple visits. Take pictures, private pictures. You go out 1 month, take a picture of 1 month from today. You go back out and you take a progress picture to see and show that you're making progress on the job site, or insofar as the transaction is going along. So I think that covers most of the idea. I don't want to rush it through, but we are running behind on time here.
All right, JP, why don't you continue with the collections on continuous monitoring, please?
Okay. To me, I jump up and down about collections because, we could do all of this work up to this time. We've lent out money to either the client or the customers, and now we have to make sure that we get paid back. So it's important for the account manager, whenever he's giving out money, purchasing, advancing money, that he knows how and when these loans are going to be paid back, whether it's on the PO side or the factoring side. Also, you have to be mindful of what is your collateral, what is your net funds employed. what we do over here is that we find it's very important to prioritize all the collections call with a descending dollar amount. And we are a big proponent on whether it's current or past due, that we put in the amount, the credit limit that has been given to that particular customer, the expiration date, and the payment trends of that customer. This will ensure that you make the calls in a timely basis. You know, we do make verification calls to make sure that the pay to information is that they are going to pay Capstone, and that the terms on the invoice are correct. There's no discrepancy, no holes on it. And we even have an online collection system, a live system, which we do every day, which queues up the collection for each collector. The collector then has a queue every day, and we put in the parameters of what he's supposed to call. So again, they look at the amounts, they review the limits, expiration dates, payment history. They're able to input the comments in there, and they input the tickler for a follow-up date. We have weekly meetings are held where the account managers, all the account managers, and the collection manager sits to review and discuss any problems with the outstanding accounts receivable. And again, we go through every client and then the whole portfolio to match the net funds employed versus the collateral, which would be the accounts receivable and the inventory. So can't stress enough the importance of this.
And it gives you an opportunity to get a jump on problems before they get to be real big problems.
Right.
Okay, when do you use field audits, JP?
Field audits, again, depending on the dollar amount exposure that you're going to have with a client. We highly recommend that this is part of the policies and procedures. These are field audits which are performed by independent third parties. And I'm just going to go through some of the things that we request that they look at here. We have the cash. They have to do the bank recs. They have to make sure that all the bank accounts are accounted for, such as the operating, the payroll, the accounts receivable. We want to make sure, or just to look at what is the customer base of the client. My favorite, the dilution. We want to run reports. The other thing we want to make sure is the concentration. Are they selling to one customer, two customers, 10 customers, and what percentage of their accounts receivable does that represent, which will come into effect when we give it a risk rating. Like, for instance, one account we had, or in fact we had two accounts lately, that they gave us an accounts receivable aging, and it looked like they had 15 debtors. And when we looked at it, we ascertained that it wasn't 15, it was 1. And they were billing, which is kind of correct. They had an account ID set up for each relationship, which was a different job. But you had to be aware of that it wasn't 15, it was 1 when we made our determination. Then you got to check on what their credit, not that their credit policy. They set lines, expirations, and the 10 top customers. And you also have to look at the inventory. One thing we like to do over here is we want to keep on top of this inventory. The account that I brought up before today, we did go over, or today, every week we go over the inventory reports. I get inventory reports from the warehouse. Upon when they get goods in, they send me a receiving report. We get a copy of the receiving report. I want to make sure it's posted. And what we do on at least once a month is go out to the warehouse and do a random physical count. We don't even tell them what's coming. So that works out pretty good. But on the inventory, the big thing you want to get is a detailed inventory aging, so you can determine what is eligible or ineligible inventory.
For example, we use a 180-day measure. If the inventory is over 180 days, it could be out of season, it could be out of style, it could be the wrong color, and many times in the past, asset-based loans never really included inventory. Someone decided to get a loan one day to lend something against inventory, and it became a standard policy that you make a loan against receivables and inventory. And many times, you go check inventory, it's the old stuff that the company can't sell. It's lost working capital that really should be liquidated. And you have lenders walking in, lending against this inventory that's of absolutely no value. So you're really making an unsecured loan. That's why we have a very strong policy against inventory. If it doesn't come in and go out, if it misses a season, if anything happens to it, it's just ineligible.
And the other things we request them to do is go over the accounts payable to see if there's any problems, and then the other items, the insurance policies, current insurance, general ledger, trial balance, schedule of notes, and taxes. Then we get a final written report with the accompanying schedules from the field auditing team. And what we'll do is, again, depending on the risk, that's why it's important to have expiration dates. We might want to say the minimum we do is every 6 months a field audit. But if we have a problem, like all of these items that we are talking about this, a red flag could go up, and we don't hesitate to send out the field auditing team, and sometimes we even go out ourselves in this to ascertain what the problem is and to, to fix it, address it.
JP, why don't you cover lockbox operations since you've got the floor?
Okay. Now, the lockbox, I guess everybody knows what a lockbox is, a centralized location to which all payments from the various clients / debtors go. This is you want to make sure you can control your collateral. You have your accounts receivable. You want to get paid. You want to have no dilution. So again, your net funds employed at the end of the day is going to get paid along with your fees. It's got to be top priority. So what we do is we send out. Let's go back. The sales that are the clients sent to us are assigned to Capstone. The remit to, or all payments are sent to a centralized lockbox. There's an overnight address for that. We have wire information, anything to get the payment in as quickly as possible. Then the invoice on each one of the sales that are assigned to us must have the logo sold and assigned to and payable to Capstone. And we put the client and customer on notice that they have to pay us, and if payment is made to any other party, it does not constitute a valid payment of this invoice. We send out notices to the clients, to the debtors of the remit to information. We follow it up with verification calls and emails. The use of the lockbox ensures that all payments are centralized in one location and can be tracked. It's deposited in one place. The remittances go with there. We are credited immediately. The dollar amount that comes into the lockbox comes to Capstone the next following business days. We have a pretty sophisticated system here with our bank. All of this is done electronically. The payments are uploaded. The remittance advices are uploaded. They come into their system, and they come in with the copies of the checks and the remittances, and are electronically put into our system by, number one, by the client, number two, by the customer, number three is the remittance, and number four is actually the invoice details, which are automatically keyed off versus the accounts receivable. This application is done automatically on the same day as it's uploaded in. So therefore, like lockbox from, let's say today, I will get details on that at about close of business at 5 o'clock. We'll get the upload files. The managers will be able to see that tonight, what came in. big picture on a summary sheet. Tomorrow we'll have the details of which everybody can see. Everybody that has clearance to look at that will be able to see the particular checks. The application is done. The payments are applied to the accounts receivable, the net funds employed, and the reserve accounts automatically. So it saves us a tremendous amount of time.
We have a question about the turnaround time for due diligence investigation. And typically what happens, we send out a checklist, and the checklist is indicates what the client needs to send to us or load up into the data room. And as the information is received and reviewed, it's checked off on the checklist. And at the end of each day during the due diligence process, the checklist goes out again with the information that's been provided marked off and the information that's remaining. And typically the due diligence goes as quickly as the client's capable of providing us with information. If something goes beyond 3 to 4 weeks, we typically don't view the transaction as something we would fund. The basic idea is if the client can't get through the due diligence phase, they are probably disqualifying themselves for the loan. So we give it 3 to 4 weeks. If the client can't handle it in that period of time, it's over. The next question is, what happens after we send out the final notice? Well, what we do is we typically refer to legal counsel. In our case, as JP and Jim alluded to, we verify that the goods have been accepted and received by the account debtor. So because we have that verification, it's very simple for us to hand over the case to a lawyer, which we have a collection lawyer, and you send out a demand letter along with the proof that the goods or services have been accepted, and they have no defense. So if you're not paid very quickly thereafter, we file a lawsuit and go for a summary judgment. It doesn't take a lot of time. So that's what we do then. Typically, because of our proactivity, very few accounts go to that level of collection. The next question is, can you talk a minute about Capstone's lending services? We typically are more of a factor than an asset-based lender. We do trade finance and purchase order financing, but we're more like a factor. And we do review credit lines weekly and monthly simply because some of our clients sell us invoices on a very continuous basis, and it seems to us that as they complete work with a given account debtor, they get more work from the account debtor. So we have to be mindful of that and make sure that the credit limits we're assigning in the system are appropriate for the volume of business the client is doing with the account debtor. Okay, I think we answered the questions. What we want to do now is just review the common due diligence failures, and Jim is going to talk about a few, and then JP will also.
Okay, thanks, Joe. Number one, the failure to conduct proper searches in the appropriate states. I mentioned that earlier in our beginning of our webinar here. I'm going to give you a recommendation. Failure to conduct the proper searches in the appropriate states. If a company is incorporated in the state of Delaware, you file the UCC 1 in the state where they are incorporated. However, if they are doing business in other states, I would recommend that you do searches in the other states, even though they're not incorporated in those other states, but they are doing business in those other states. You still should do searches in those other states. All right. Number two, failure to file lien on time and extensions. If you don't file that lien on time, if you don't file that lien before you actually lend or buy an account receivable, you're in big trouble. The same thing with your extensions. If you have a 5-year UCC timeline, if it comes to 5 years, you forget to extend it, you're going to fall in between someone that might come right behind yourself.
I want to give an example of what happened in our portfolio a couple of weeks ago.
Yes, we have a client that was a senior lien holder to us, which we were able to obtain a limited subordination for. We did a recent search. We do quarterly searches on some of our larger clients and found that their UCC1 expired, and we became senior to their lien. So it's just an example. We notified the first lien holder and told them, look, you didn't file your extension, and now we're the senior lien holder. But we're working with them. We're not here to cause problems with the first lien holder. So I guess the receiving transaction information on the related personnel is not mine. So that's
JP. JP is going to talk about that.
Yeah, I just want to make a point here that you have to, on all the documents that you receive from here, like either a PO request, a verification request from the client, that it is a document that is signed by either the customer or the client that is an officer of the particular company. And that if that is not an officer, you should not go along with the transaction. Or if they have a designated person, you should receive a letter in writing from the officer of the company designated an authorized signee.
JP, to that point, I mean, I've seen many times when a client files bankruptcy, the first thing the unsecured creditors or anyone who is looking to get collateral, they'll look immediately at who authorized the borrowing.
Right.
And if they don't have an authorized party, they try to invalidate that and remove it from the lender's collateral.
Right. And in fact, Jim had a case today that he did one of the verifications, and I think it's something to be brought out about the one you received the email from the client versus the debtor.
Yes, we did. We sent out an email for verification and directly to the account debtor, and it came back through the client. So I kind of scratched my head and said, how did that happen? So what I did was I resent the email directly to the person who did verify it, signed off on, and asked for it to be authenticated. So they did so, and we went forward and funded the deal. But you got to watch. You send it out to somebody, doesn't come back from that person, find out why.
I want to talk about contact with the client. A lot of times, at least the younger people in the office, they tend to do everything by text and email. And I've found over the years that speaking with the client presents a tremendous amount of information about their demeanor, and you can tell from having consistent contact with the client what's going on, whether they're under stress, whether things are going well, whether they've got a new problem, who knows what. A lot of things can affect your loan. So you have to be very mindful of that, and you have to stay in consistent contact with the client so you get to know them. Same thing with site visits. You can't have too many site visits. And sometimes you have people who lend all across the country. If they're far away, we make sure we meet them at a minimum of once a quarter. And you got to act like the Romans did. You got to plant the flag, out of sight, out of mind. So you should be in touch with them as much as possible in person. JP?
Another common due diligence is very accessible to determine if you have all the necessary documents. And also over here, this will enable everyone here who has authorization to be able to verify and confirm that the folder content is indeed complete.
And you have to be skeptical at all aspects of the due diligence so that you're always asking questions, because when you ask questions, you're better informed. I want to give you a couple of takeaways, and then we're going to end the webinar. Number one is you got to act like Ronald. up after this is over. We would be very happy to answer them. You can email us your questions, and we appreciate your participation. We have one question. Tim, can we keep going with questions, or do we have to end it?
Sure, yeah.
Okay.
People, let's just say goodbye. For those of you who have to leave us now, thank you for joining us. But if you can hang on the call and hear a couple of questions being answered, you're very welcome.
The question is, in addition to D&B reports, do we check other sources to verify? You want to handle that, Jason?
Yeah, sure. I mean, to me, we use a D&B. We had a discussion today with Jim about the use of D&B. What we do is we use that as a basis, and then like today we had a big account that we are, or Jim requested the committee to look at a $500,000 line. So we received the D&B. We use that for a basis to say that it looks, again, rated quick check number 1. Now we are going through our own due diligence write-up process, which would mean that you contact the bank, you contact the customer for verification of the information on the D&B. I don't know if that answers the question.
Yeah, to embellish that a little bit, the D&B is your first line of defense. If you get a D&B and it's not sufficient, you know you have to collect more data. Let's give them an example. We did a credit underwriting of an account, had an excellent D&B report. What was it? Was a significant net worth. They had multi-million-dollar account balances, but they don't pay. They don't pay their bills. Okay? It takes 120 days, constant effort by the account debtor to get paid. So because of their net worth and because of the kind of work the client of ours is doing for them, we reduce the advance rate and reduce the credit line so that we can continue to support the client knowing that we're going to get paid in 120 days. So you not only have to take the D&B report and the third-party information that you can collect outside of D&B, but you have to take the actual performance of the customer. And this is why we review the credit report, the credit line monthly and weekly, is because if you're not getting paid and you're attempting to communicate and they don't communicate with you, you would ratchet back the credit because you're going to be surprised one day, and you don't want that surprise to be, hey, you know, these guys are out of business. In this particular case, the bank was re-verified, trades were re-verified, all the credit information came back good. They're just a very slow payer. And there's nothing you can do about that, so we adjusted the advance rate. Are there any other questions? Okay, well, thank you for your time, and we look forward to talking to you.
Thank you, everyone.
Have a good day.
And thank you so much. We really appreciate you taking the time, both to our audience to joining us and to Capstone. Thank you very much for a very informative presentation. I saw by the comments coming in that people have obviously found that really worthwhile. So thank you.
Okay, take care, Tim.
Thank you.